Should I apply for a cash flow term loan or not? Call 888-653-0124 today or click the link in the description to learn more. A cash flow term loan is a type of short-term loan where you borrow money against your future income. If you need some extra cash right now, why not apply for a cash flow term loan? We all know that banks don't lend money to people who aren't good credit risks. So what happens when you apply for a cash flow loan? If you're wondering if you should apply for a cash flow short-term loan, then read this article to find out. How a cash flow loan works. The borrower receives a lump sum payment from the lender at the start of the loan period. This amount will cover all business expenses during this period. At the end of the loan period, the borrower must repay the entire loan plus interest. If they fail to pay back the loan, the lender can take legal action against them. Cash flow financing allows you to get the cash you need without having to wait until your next payday. It's perfect for small businesses because it gives you instant access to cash and doesn't require collateral. Cash receipts and cash payments are recorded on the books of account of the company. The difference between these two amounts is called cash flow. This cash flow is then used to meet the day-to-day needs of the business. A cash flow term loan works similarly. You receive a lump sum of money at the beginning of the loan period. Then, you use this money to pay off any outstanding debts. After the loan ends, return the remaining balance to the lender. Example of a cash flow loan. The most common type of cash flow loan is the revolving line of credit. This is where a business borrows money from a bank at regular intervals, usually monthly. The amount borrowed will depend on the needs of the company and its ability to repay the loan. Cash flow gaps occur when there are insufficient cash flows to cover all the costs involved with running a business. When this happens, companies often run into financial difficulties. As a result, their employees may be laid off, and customers may stop buying products. When you apply for a cash advance, you're borrowing money based on the value of your expected future earnings. However, you'll only get paid once those earnings come through. You could also apply for a cash flow advance if you want to buy something expensive but don't have enough saved up. Future cash flows will help you make the purchase. How cash flow loans are different. The major difference between a business loan and a cash flow term loan is that a business loan is usually paid back over a longer time, usually 12 months. This means that it will take longer for the money borrowed to be repaid. Having positive cash flow is important to ensure that a business continues to grow. For example, if you're selling goods or services and you don't have enough cash coming in to cover your bills, you won't be able to keep providing those goods or services. This might mean that you have to cut down on staff or reduce the number of hours worked. In addition, you might be forced to close your business altogether. In contrast, a cash flow term loan provides you with a lump sum of money upfront. This makes sure that you can continue to provide goods and services while paying off your debt. A cash flow loan isn't always better than a traditional business loan. Some types of business loans offer more flexibility than others. For example, some business loans allow you to spread out payments over several years. This means that you won't have to pay back the entire amount at one go. In addition, other types of business loans give you the option of increasing the amount you owe each month. This helps you manage your finances effectively and avoid going bankrupt. Cash flow statement for term loan. The following information should be included in a cash flow statement for a term loan. Interest rate. Loans for cash flow term loans are fixed interest. The interest rate depends on the length of the loan. It starts at around 0% and increases during the first year. Period of the loan. Businesses must repay the full amount within the agreed upon repayment period. If they cannot do so, they will face late payment charges. Repayment terms. Repayments should start after the loan. Once the loan has been fully repaid, the borrower is required to return the money plus any accrued interest. Amount of the loan. The total amount of money lent must be stated on the cash flow statement. Date of the loan. This should be recorded along with the date of its inception. Payment history. This shows how much was paid towards the principal and interest on the loan. Payments made. This shows whether the borrower has made regular monthly payments. If not, then the reason should be provided. Business cash flow statements are useful tools when preparing financial reports such as cash flow projections and balance sheets. A cash flow statement for a business loan includes all the relevant details about the loan, including the amount borrowed, the interest charged, the amount of payments received, the amount of outstanding debts, and the amount of profit earned. Projecting cash flows. The first step is to determine what type of business you're running. If it's a restaurant, then you'll need to calculate your average daily sales. Next, divide this number by 365 to find out how many days you will need to generate those sales each year. Then multiply your total annual revenue by 12 to figure out how much money you need to raise. Cash outflows include all the costs associated with generating cash from sales. You'll need to add up all your outgoing bills and subtract them from your income. For example, if you spend $100 per day on rent, you'll need to deduct $100 from your net income. You'll also need to record all the incoming payments into your accounts. Incoming payments could include deposits from customers, invoices from suppliers, rents and wages paid to employees. Once you've calculated your cash inflows and outflows, you can use these figures to prepare cash flow budgets. Cash flow-based loans are usually easier to get than traditional bank loans because they don't require collateral. However, they can be harder to qualify for than conventional loans. Cash flow budgeting allows you to see where your company stands financially. Using this method, you can make better decisions regarding which projects to fund and which ones to cut back on. When developing a cash flow budget, consider your current debt levels, how long it takes to pay off existing loans, whether you have enough reserves to meet unexpected expenses, the time to earn additional income, what kind of growth potential you have, whether there are any negative factors that might affect your ability to increase your revenues. Besides helping you manage your finances, a cash flow budget can help you plan for future growth. It lets you know how much money you need in order to expand your business and create new jobs. It's important to note that cash flow budgets only work if you stick to them.